Welcome to FIN 500, Foundations of Finance. This video will discuss financial statements, the first key topic in the Foundations of Finance series. We'll cover financial statements, their importance, and how to interpret the three main types: the balance sheet, income statement, and cash flow statement. Let's break it all down in simple terms. What are financial statements? Financial statements provide a snapshot of a company's financial health. Just like a doctor might use medical tests to assess your physical health, businesses use financial statements to determine their economic health. These statements give a detailed record of a company's business activities and performance over a specific period, whether it's a month, a quarter, or a full year. Without these statements, stakeholders, such as investors, lenders, and company executives, would have no way of accurately measuring a business's performance. Why are financial statements important? Financial statements serve several critical purposes. Let's break them down. 1. Understand financial health. Financial statements reveal essential financial data, including a company's revenue, how much money it's earning, expenses, how much it's spending, profits, and debts. For business owners and managers, this information helps answer questions like: 1. Are we making enough profit to cover our expenses? 2. Can we afford to invest in new projects or equipment? 2. Aid investment decisions. Financial statements are a crucial tool for investors. Imagine you're considering investing in a company. By examining its financial statements, you can determine if the company is profitable, sustainable, or deeply in debt. Money back. For example, a company might have impressive sales figures, but if its expenses are out of control, it may not generate any real profit. Without reviewing these documents, you might invest in a business that's on the verge of bankruptcy. The three main types of financial statements. Now that we know why financial statements are important, let's break down the three main types. 1. Balance sheet. The balance sheet is like a financial snapshot taken at a specific point in time. It answers: what does the company own and owe right now? The balance sheet is made up of three key components. 1. Assets. This is what the company owns, such as cash, inventory, equipment, or property. 2. Liabilities. This is what the company owes, such as loans, accounts payable, or other debts. 3. Owner's equity. This is the residual value that belongs to the company's owners after liabilities are deducted from assets. Here's the formula for the balance sheet. Assets equals liabilities plus owner's equity. Think of it like a house. If your home is worth $300,000, an asset, and you owe the bank, let's say, $200,000 on your mortgage, a liability, the remaining $100,000 is your home equity. The balance sheet gives you a clear understanding of a company's current financial position. 2. Income statement. The income statement, also known as the profit and loss statement, covers a period, usually a month, quarter, or year, whereas the balance sheet shows a snapshot. It answers the question: is the company profitable? The basic formula is simple. Sales, revenue, expenses equals profit. Let's break it down further. 1. Revenue. the money a company earns from its main operations. 2. Cost of goods sold, COGS, the direct cost of producing or acquiring the goods or services sold by the company. 3. Operating expenses, day-to-day business expenses such as salaries, rent, utilities, and marketing. 4. Profit, the amount left over after all expenses are deducted. 4. This is often referred to as the bottom line. For example, if a company earns $500,000 in sales but has $400,000 in expenses, its profit for that period is $100,000. This tells investors and managers whether the business is operating efficiently and generating returns. 3. Cash flow statement. The cash flow statement tracks the cash movement into and out of the business. While a company may show a profit on its income statement, that doesn't always mean it has enough cash on hand. The cash flow statement is divided into 3 sections. 1. Operating activities. This is the cash generated or used by the company's core business operations. 2. Investing activities. This is the cash spent on or received from investments in assets, such as buying or selling equipment or property. 3. Financing activities. This is the cash received from or paid out for financing activities, such as issuing shares or repaying loans. This statement is essential for understanding a company's liquidity or how easily it can pay its short-term financial obligations. See below diagram. Overview of financial statements. Here's a visual summary of how these 3 statements fit together. Financial statements. Balance sheet, income statement, cash flow statement. Assets, liabilities, revenue, expenses, operating, investing, equity, snapshot, profit, loss, financing activities. This diagram highlights how each statement serves a unique purpose while working together to provide a comprehensive picture of a company's financial health. The key takeaway: think of financial statements as a company's report card, a critical tool that shows how well or poorly the business is performing. Just like report cards help parents and teachers assess a student's academic progress, financial statements provide key stakeholders, such as investors, managers, creditors, and regulatory bodies, with insights into the company's economic progress and overall health. Financial statements are essential for investors in evaluating whether investing in a company will yield positive returns. Investors look for signs of profitability, growth potential, and risk factors. Without financial statements, investors would be left guessing whether a company is stable, growing, or on the verge of collapse. For managers, these statements are strategic tools for decision-making. Managers use financial statements to plan budgets, control costs, forecast future performance, and evaluate the success of current business strategies. For instance, a detailed review of cash flow might reveal a need to improve how quickly the company collects customer payments. Financial statements provide a basis for determining creditworthiness for creditors and lenders, such as banks. If a company applies for a loan, the lender will assess whether the business has sufficient assets and cash flow to repay its debts. Without this information, lenders would have no objective way to determine risk. Finally, government and regulatory agencies use financial statements to ensure compliance with financial reporting standards, assess tax obligations, and monitor the financial stability of industries critical to the economy. Without financial statements, making informed financial decisions would be nearly impossible. Businesses would struggle to attract investors, secure loans, or even maintain day-to-day operations. Inaccurate or missing financial data can lead to costly errors, poor financial planning, and even business failure. This is why financial statements are a cornerstone of transparent and effective business operations, ensuring that all stakeholders have access to reliable and relevant financial information. Closing statement. That's it for Lesson 1 on financial statements. In our next video, we will examine cash flow, including how businesses track and manage their money. Be sure to like, share, and subscribe so you don't miss any future lessons. Thanks for watching, and see you next time.